Hi, everybody, and welcome to today's webinar. Thank you for joining us. Today, we're going to run through some of the tax updates that were released by the various authorities during the December quarter. Joining me today to present, I have Grace Simmons from our indirect team. She's a specialist and she's going to run through all the indirect tax updates. We also have joining us Larissa Lai, a partner from our R&D team. Larissa's recently joined us at RSM, so very excited to have her to go through some of the R&D changes over the last quarter. My name's Belinda Crowley. I am a director in the corporate tax team, and we'll begin with all the corporate tax updates. So Grace, we'll just move to the agenda. I'll run through what we're going to discuss today. So first of all, in the corporate tax updates, there's a little bit of superannuation things to run through. There's a case there. We've got some beneficial ownership reporting changes, an exposure draft there. I'll quickly talk to that, as well as some of the reports that the ATO's released at the end of last year, just around its findings in respect of its review and audit programs. There's a couple of changes in the international space, in particular around thin caps, some new guidance. Also just a quick update on BEPS 2 and some country by country reporting changes. Grace has a few indirect tax updates to run through, in particular from Victoria and New South Wales, and also a new GST ruling that the ATO's put out. And then Larissa is going to talk to some of the upcoming key deadlines with R&D and also a few case developments in that area. So I'll start with the corporate tax updates and in particular some of the superannuation updates. So I'm going to begin today by talking about a case from the AAT, the Peter Hatfield Trust and the Commissioner. So this is a super guarantee charge case. It's particularly dealing with the extended definition of employee under the SGC Act. So just briefly, the facts were as follows. The Hatfield Trust had engaged Mr. Hargraves, who was a plumber, to provide plumbing services to the Trust's clients. The engagement had run over several years, and the Trust had assessed Mr. Hargraves to be a contractor, and in particular that he didn't meet that extended definition of employee under the SGC Act. Obviously, that extended definition is someone who works under a contract principally for their labour. Mr. Hargraves' contract was a verbal contract, it wasn't in writing, and there had never been any discussion around the right to delegate the work that Mr. Hatfield did. Most relevantly for this particular case, Mr. Hatfield was paid on an hourly rate as opposed to a per job rate, and it wasn't a fixed amount that he was paid for the job, it just depended on time spent on it. Mr. Hargraves contended that he was an employee and he went to the ATO. The ATO agreed with him and they raised SGC charges against the Trust, and the Trust then disputed those in the tribunal. So just quickly a refresher around, I guess, the relevant law here and that extended definition of employee in the SGC Act. That definition requires 4 parts. It requires there firstly to be a contract. The contract needs to be wholly or principally for the labour of a person. So where you have contracts which have materials or a goods component, they may be excluded. The contract needs to be for labour as opposed to a contract for a result, which was the key point in issue here. And the person must also work under that contract. So as said, here the key point of contention was whether the contract was for a result. I think rightly or wrongly, a common consideration when sort of looking specifically at this issue has been the form of remuneration that the individual receives. So whether they're paid on an hourly rate versus on a sort of fixed quote for the job basis. The Commissioner's position has generally been that remuneration on an hourly basis is inconsistent with a contractor and also inconsistent with a contract for a result. The ATO has recognised some judicial commentary from JMC, which was a High Court case from 2 years ago now, I think, which did provide commentary that an hourly rate is not inconsistent with an independent contractor relationship, but the ATO largely confined those findings of the court to the circumstances of the JMC case. Next slide, Grace. So in Hatfield, a win for the taxpayer. The tribunal found the arrangement was a results-based arrangement and therefore that it wasn't a contract for labour. The tribunal said in particular that the hourly rate was simply an effective measure by which to charge for each job. All invoices set out the hours spent on each job and that he was paid for those jobs accordingly. Mr. Hargraves was paid for time spent on each job rather than a fixed fee per job. No quotes were given, and that the structure was common in situations where the exact cost is unknown. So it was quite encouraging here that the tribunal took quite a commercial lens to this. They sort of felt that not all jobs can be quoted on a fixed fee basis, and so it would be appropriate in certain circumstances that you get paid on a time cost basis. And that form of sort of payment isn't determinative of whether you have an employee or a contractor relationship. The ATO has appealed this case, so we will have further commentary on it, but for the time being, I guess a positive development in that area. Next slide, please. Just two other quick superannuation updates before I move on. So the ATO has released some additional guidance in relation to the remission of interest and penalties in relation to SGC assessments. It's an update to the PCG 2021-3. They now have a very detailed 4-step process for the remission requests. So it will be important to the extent that you are applying for those that you follow that process closely. It now sets out quite clear instructions around the factors that ATO staff should consider when considering a remission request. And it also has it certainly needs to be referred to in any request for remission. There's also a new payday super fact sheet that's been released. Reminder, payday super is to begin on the 1st of July 2026. The fact sheet contains some additional details. It confirms that the super must be paid within 7 calendar days of the wages payment. Previously, we had limited guidance around that. And it's also hinted that there's going to be some changes to the interest and penalty regime around SGC, in particular increased penalties for employers who are consistently late with the payment of SGC. So certainly there'll be further updates between now and 1 July next year around this area. Thanks, Grace. The next one is the beneficial ownership reporting changes. So this is an exposure draft which sets out some additional reporting and disclosure requirements for entities. This is part of a greater trend towards tax transparency that's taking place globally, but it's also there to support efforts against money laundering. I think the government feels that the lack of knowledge of corporate ownership structures is facilitating that. The exposure draft itself expands the interest, which are now subject to reporting, so goes beyond just shares to derivative interests as well. ASIC now also has a greater ability to trace through entities and to request that entities provide information in order to allow them to trace through. In particular, this also applies to foreign entities, which it hadn't applied to in the previously. There are also some proposals for private companies. So private companies will be required to collect, verify and record information around their beneficial owners. Trusts and partnerships are also included. Previously, there's been no real requirements around those entities in terms of reporting. The changes are there to be implemented in 2 stages. The first is going to make the information available to journalists, academics, regulators and other law enforcement agencies. And then the second phase will make the information available to the general public. Obviously, some of this information is already available on ASIC for a fee, but presumably now it will be available free of charge. these changes are sort of implementing a positive obligation on companies and trusts to gather this information, which will no doubt be an additional compliance burden for them. Just also interesting to note the interplay with the recent announcement that the Australian Business Register will move to ASIC. It's currently governed by the ATO. So obviously all the business registers and reporting now aligned under ASIC as opposed to the ATO. It's obviously an exposure draft at this stage. Comments are being taken, and so there will likely be further updates on this. Onto the tax transparency reports that have been released in the last quarter. So there's been a couple, the key ones being the corporate tax transparency report, the top 100 and top 1000 reports, and there have also been some reports around employment taxes and GST, and Larissa will touch briefly on the R&D report that's also being released. The report covers off disputes or reviews completed or undertaken in the 23-24 year. Some of the key findings from that report, 2.2 billion was voluntarily paid to the ATO as a result of preventative compliance intervention. Global profit shifting is obviously a major focus of the ATO, and the findings from the report reflect that. 70% of the audits or currently underway involve global profit shifting issues, and 30% of those audits had anti-avoidance issues in them, which is interesting given that the ATO has had a few losses in recent times around the Part 4A provisions. Transfer pricing and debt financing also remain really key risk areas and concerns to the ATO. Which brings me to the international updates that we have. We have just a couple. Main one is the thin capitalisation, which we've received some new guidance on. So during the quarter, the first guidance on the new thin capitalisation provisions has been released. Just a quick refresher, so the new thin capitalisation provisions applied from 1 January 2023, and they introduced 3 new tests to determine interest deductibility, those tests being the fixed ratio test, the group ratio test, and the third-party debt test. The PCG itself has 2 parts to it. The first part provides guidance around the operation of the third-party debt test, and the second gives guidance on how the ATO is to apply its compliance resources to restructures that are aimed at reducing the impact of the debt deduction creation rules that were introduced in conjunction with the thin cap provisions. The ATO has indicated that there is further guidance to come, which is aimed around restructures that are attempting to mitigate the impact of the thin cap provisions more broadly. In relation to the guidance around the third-party debt test, so this test itself is quite restrictive. It allows a debt deduction for third-party debt only and no debt deductions for any related party debt. Even within that third-party debt, though, there are quite specific requirements that need to be ticked off. The key ones, I guess, that make it difficult to apply more broadly are that the debt must be used only to finance Australian operations, and it cannot be guaranteed by any overseas entity or any overseas assets. So just in relation to those definitions, there are sort of several open terms, if I could describe them as that, that the ATO's guidance touches on. I've just got up there on the slide the 2 sort of key restrictions that I'm referring to. The first one there is that disregarding recourse to minor or significant assets, the lender only has recourse to covered Australian assets. So this is a reference to that limitation around what you can use to guarantee the debt. The second requirement there is that substantially all of the proceeds are used to finance Australian operations. So I'll just move on to the next slide. So I've got listed up there some of those key terms which the guidance provides the ATO's view on. Just in relation to the term recourse, the ATO has helpfully confirmed that it doesn't require borrowers to look through obligations owed to or the rights of an obliger. So, for example, for the purpose of the test, a lender isn't required to consider the assets of an investor when they're considering whether they have recourse to those assets. In relation to minor and significant, this unfortunately has been given a really strict interpretation by the ATO. So just keeping in mind that we're looking here at the assets which the lender has recourse to, and those assets that we can disregard on the basis that they're minor and insignificant. The ATO's example that it gives is a $2 amount of foreign share capital. So they've really taken a literal approach in their interpretation here. There is a concession that applies up until 1 January 2027, which allows an entity to treat as minor or insignificant assets up to that are less than 1% of its total assets, but that does have a cap of $1 million. So, and only applies up until 1 January 2027. There's also some guidance in relation to Australian assets, although it is quite limited and it deals more with what aren't Australian assets as opposed to what are Australian assets. So, for example, a CFC would not be an Australian asset or an Australian company which has a foreign branch. It doesn't, however, touch on some of the more, I guess, contentious issues, like, for example, intangible assets, whether they are Australian assets. In relation to commercial activities in connection with Australia, again, it's been given a very narrow interpretation. The ATO's view is the relevant borrowed funds must be used in Australian operations of trade or business capable of generating a profit. So they can't be used in distributions, can't be used in capital management activities, or in the indirect purchase of foreign assets through an Australian entity. Further, there only a minimal or nominal amount of the relevant proceeds can be used for activities outside of Australia, given the interpretation that they've given to minor and significant assets. You would suggest that they will apply a similar interpretation to that minor or nominal requirement in relation to the activities outside of Australia. So I think that the guidance certainly doesn't make the third-party debt test easier to use, and it makes it even more important that if taxpayers are going to seek to rely on this test, that they really ensure that they're ticking all the boxes to make sure that it applies. Just next slide, Grace. The other part of the guidance deals with restructures to avoid or to mitigate the implications of the debt creation rules. So I think that ATO has taken a view that taxpayers might try to restructure their arrangements in order to get a more favourable outcome. So the PCG outlines a framework for firstly assessing whether the debt deduction creation rule will apply, and then assessing whether the restructure is likely to cause the ATO concern and therefore have resources applied by them. Just quickly as a refresher, so the debt deduction creation rule applies to deny deductions on funds that are borrowed from associates, to either acquire an asset from an associate or to fund payments to shareholders, so such as dividends, capital returns, royalties. The guidance deals with the general anti-avoidance provisions in Part 4A, and it also looks at the specific anti-avoidance provision that is within the debt deduction creation rules themselves. The guidance is set out in 2 schedules, and it does take the rating system form that we've recently seen in the ATO's compliance guidelines, similar to interest deductibility there are multiple examples in the guidance of what is high and low risk, just in terms of some of the key takeaways. So the rule does apply at the time of borrowing. The ATO has confirmed that. So to the extent a taxpayer borrows from an entity that is not an associate, which later becomes an associate, then there's no application of the debt deduction creation rules in that case, because at the time of the borrowing, that entity wasn't an associate. There are some examples in the guidance around Division 7A. And just a reminder, because these apply to sort of Australian private groups as well, they potentially apply to any group which has international ownership of 40% or more, or a foreign investment of greater than 10%. So any private groups with sort of international operations, they'll really need to be mindful of this, because the sort of intergroup financing is quite a common arrangement in a private structure. There is within the PCG some commentary around the ATO's expectation of documentation, sort of documenting the application of the debt deduction creation rules, which is not dissimilar to their guidance around the hybrid rules, in that it sort of states within the guidance that taxpayers shouldn't claim a deduction unless they have fully documented their position. So the position documentation would obviously need to look firstly at whether the debt deduction creation rules apply in that circumstance, and then whether there's been anything, any restructures to get out of them. It does look like that ATO requirement for documentation is the start of a bit of a trend in that area. Next slide, please. And just finally, around this thin cap, the ATO has released the approved form for the elections for the new thin capitalisation provisions. So just quickly, if you are seeking to use the third-party debt test or the group ratio test, you do need to make an election. It needs to be in the approved form. The website there, which has the form, is just on the slide for those of you looking to do it. It needs to be completed before lodgement of the tax return in the relevant year. Finally, just some quick updates around the Pillar 2 legislation and country-by-country reporting. All the bills in relation to Pillar 2 are now passed with minimal amendments, so they have effect for income years ending on 31 December 2024. So those taxpayers who are caught by those rules certainly need to be addressing those at this stage. There have also been some announcements around the country-by-country reporting exemptions, which are generally to be scaled back. There were some concessions that the ATO had allowed for groups with small amounts of international related party dealings. So now all country-by-country reporting entities will be required to lodge a short form local file and a master file for periods that begin on or after 1 January 2024, even if they have no dealings. There are some very sort of niche exemptions. For example, if your group has no international operations whatsoever. Exemptions will also now only be granted for 1 year at a time, and you do need to apply to the ATO on a case-by-case basis in order to apply those exemptions. And so that is all from me on the corporate tax side. I'll now pass over to Grace, who's going to run through the indirect updates.
Thanks, Belinda. So the first area of updates that we're going to run through is some updates to Victorian state taxes. The Victorian CIPT regime has now been in operation for about 6 months. As a refresher, the CIPT regime scrapped land transfer duty or stamp duty and landholder duty on commercial and industrial properties and replaced it with an annual property tax. Eligible properties will transition or have already transitioned to the CIPT regime, where an eligible dutiable transaction or a relevant acquisition occurs after the 1st of July 2024, and that's known as the entry transaction. The date of the entry transaction is the start date for the 10-year period, after which CIPT will begin to apply. During the time that the CIPT regime has been in operation, a range of practical considerations and challenges have arisen. In particular, entities looking to acquire land or landholding entities in Victoria should be wary of the effects of the regime in the drafting of the relevant sale agreements. Clients looking to buy property acquire landholding entities in Victoria should be mindful that they may need to take extra steps during the conveyancing process in order to be across the CIPT position of the land in question. This might be achieved by adding additional clauses which explicitly call out whether or not the property falls within the CIPT regime or is already in it, and what the valuation code is for the land in question. The Victorian State Tax Further Amendment Bill has also received royal assent. Amongst other things, it contains some amendments that provide a partial payroll tax exemption for wages relating to GP medical businesses that bulk bill from the 1st of July 2025. The amendments also extend the period in which the Commissioner can reassess an employer's payroll tax liability in certain circumstances. And just in the context of Queensland, the government has also committed to introducing a similar exemption from the 1st of July 2025, which is when the current amnesty that is in place will end. The short stay levy bill in Victoria, which introduces a short stay levy, also known as the Airbnb tax, at a rate of 7.5% of the total booking fee for a short stay accommodation, for a short stay in short stay accommodation from the 1st of January 2025 is now law. Notably, the levy doesn't apply to a booking that has been made before the 1st of January 2025, regardless of whether the actual stay occurs after the 1st of January 2025. In the context of this levy, a short stay is considered a stay of less than 28 days, and the relevant premises must obviously be in Victoria and satisfy the definition of short stay accommodation. As a result, premises that are occupied as the principal place of residence of the owner or renter of those premises, as well as commercial residential premises and certain other very specific types of premises have been excluded from that definition. Liability for the levy arises on completion of the relevant short stay and is imposed on the booking platform or on the owner or renter of the relevant premises where a booking has been made directly or privately. Those liable are required to apply to the Commissioner for registration and lodge returns. Returns are lodged annually unless the total amount collected from short stay bookings is more than $75,000 in a year, in which case the taxpayer will be required to lodge quarterly returns. Moving now to New South Wales. From the 1st of January 2025, for the 2025 land tax year, the foreign purchaser surcharge duty will increase from 8 to 9%. The surcharge applies to foreign buyers of residential property in New South Wales unless an exemption is available. And what's interesting about this is the fact that from the 1st of July 2024, in Queensland, we actually raised our surcharge rate from 7 to 8% to be consistent with the rates that were in New South Wales and also Victoria. So it'll be interesting to see whether in the next budget in June, whether the Queensland surcharge rate is raised again to align with the other states. Revenue New South Wales has also issued updated guidance on payroll tax relief for medical centres engaging contractor GPs, a very hot topic in the payroll tax world at the moment. The updates reflect the Revenue Legislation Amendment Act 2024, which amended the New South Wales Payroll Tax Act to provide an exemption for unpaid payroll tax on relevant GP wages prior to the 4th of September 2024. A rebate of payroll tax paid by medical centres on payments to GP contractors under prescribed billing arrangements, which is effectively where patients have been bulk billed, has also been introduced. The New South Wales Parliament has also initiated an inquiry to investigate and report on the application of the Contractor and Employment Agency provisions in the New South Wales Payroll Tax Act. The inquiry will consider revenue rulings and Commission of Practice notes addressing the relevant provisions, decisions of the courts in cases involving the application of these provisions, and the applicability of the provisions on certain industries. It's taking a particular focus on the on-demand and gig economy. The reason for the inquiry being called is because we've seen various rulings in court cases such as Uber, Thomas and Nas, and Optical Superstore, along with a range of employment agency cases, which arguably go far beyond the original intended scope of these provisions. Broadly, the inquiry is seeking to consider whether the rules are fit for purpose or whether they need to be reset or otherwise amended to rein in the way the Revenue Office is applying the provisions against various different industries. And now onto a new ATO ruling on tax credit time limits. The ATO has published Miscellaneous Tax Ruling MT 2024-1. The ruling sets out the Commission's view on time limits applying to the entitlement to an input tax or a fuel tax credit, as set out in subsection 93(5) sub 1 of the GST Act and subsection 47(5) sub 1 of the Fuel Tax Act. These are known as the limiting provisions. The limiting provisions provide that unless an exemption applies, a taxpayer's entitlement to a tax credit, so either an input tax credit if we're talking about GST or a fuel tax credit if we're talking about fuel tax, ceases to the extent that the tax credit has not been taken into account in an assessment during the 4-year period. The ruling is a welcome addition as it provides greater clarity on when and the extent to which a tax credit has been taken into account in an assessment. The ruling also explains when the 4-year entitlement period starts and therefore when it ends, and instances where there is an exemption or an extension of the time limits. Not many cases. The ruling also explains when an objection to an assessment may preserve a taxpayer's entitlement to a tax credit and the interaction between the limiting provisions and private rulings and amendment requests. The ruling applies both before and after its date of issue. And I guess to summarise the key messages of the ruling, it's quite clear that the Commissioner has a very narrow or limited view as to when you can get a credit outside of the 4-year period. Effectively, the Commissioner's position is that taxpayers have 4 years to claim their credits, and if not, they lose them. It's a use it or lose it type scenario. So I guess the key takeaway from that is if you're ever in a scenario where you become aware that you're approaching the end of the 4-year entitlement period, or you worry that you might be, come and speak to us and we can consider your options and the best way forward. So that's everything from me. Now over to Larissa for the R&D updates.
Thank you, Grace. Great to meet everyone. As Belinda mentioned, I'm the new R&D tax partner here in Brisbane and looking forward to taking you through some R&D tax updates over the last quarter. So the first update here is that the R&D Tax Incentive Transparency Report was published at the end of 2024. This is in line with some new legislation. This was the first transparency report published, and it does include details of R&D claimants and their total R&D expenditure for the 2021-2022 income year. The ATO's view is that by publishing this information, it will provide transparency on the benefits received by R&D entities. It will encourage voluntary compliance with the requirements of the R&D Tax Incentive Program, and it will increase public awareness of each company's R&D tax incentive claims. RSM did release a report in relation to the data that was published in the transparency report. Some of that data that we did review demonstrated that there were 11,545 companies that did submit claims in the 2021-22 income year, and their reported spending was $11.2 billion. It would be no surprise that the highest number of claimants for the R&D tax incentive fell within the IT and computer services sector, and the health and life sciences sector had a high average R&D claim amount. The next point there is if you are a 30 June 2024 year end and you've not yet submitted your R&D claim, the deadline for the R&D application form is quickly approaching, and that is the 30th of April 2025. If you are looking forward to your 30 June 2025 year end, now is a good time to identify any of those R&D activities that would meet the legislative criteria of what is an R&D activity and start to prepare and finalise supporting documentation of those R&D activities before the year end. If you are looking to capture some of the R&D activities that you've performed overseas, it will be important for you to prepare and submit an overseas finding application. This will need to be lodged on or before the 30th of June 2025. Some recent updates. So earlier this year, the federal government Future Made in Australia bill passed the Senate, which is exciting news. This legislation does introduce two new tax incentives, the first being the hydrogen production tax incentive, and the second being the critical minerals production tax incentive. These are production tax credits, and it is exciting to see that the federal government is supporting these two industries, and hopefully that will attract overseas investment into Australia, particularly in these sectors. On to the next slide. Thanks, Grace. So the ATO does still remain focused on two particular issues. The payment to associate provisions, which really focuses on ensuring that where you are claiming the R&D tax offset in relation to payments that you have made to an associate, that before the year end, you have both incurred and paid that expense. So when we talk about being paid, we expect that there is a constructive payment being made before the R&D tax offset is claimed in relation to that payment. The second focus area of the ATO, which we are seeing a lot of ATO review, is in relation to inbound companies coming to set up into Australia and undertaking R&D activities and claiming the R&D tax offset in relation to those activities. We're seeing a lot more focus from the ATO with respect to Australian subsidiaries who are claiming the refundable R&D tax offset. So it is important that when claiming the R&D tax incentive, that you are looking at what those structures are between the foreign parent entity and the Australian subsidiary, and making sure you're aligning with recent ATO guidance in relation to that. There has been some movement in terms of the strategic examination of research and development. So there was an expert panel appointed last year, and only yesterday, the 12th of February, the discussion paper in relation to this was released. So the R&D tax incentive continues to play a central role in any future funding mechanisms for R&D. Given that central nature, the expert panel may consider different features in relation to the R&D tax incentive. Some of these could be increasing the refundable threshold from 20 million to 50 million. It could also include looking at the intensity threshold, complexity of the current non-refundable R&D tax offset. There could be consideration of the collaboration premium and whether or not quarterly credits may be implemented. RSM will be looking to be involved in discussions, particularly around this discussion paper that's been released. Thank you, Grace. There have also been two relevant decisions that have come out, which are worthwhile noting. So the first there is a federal court decision, came out late last year. This is in relation to a taxpayer who was claiming the R&D tax incentive in relation to the modification of a athletic shoe design. In this particular case, the judge did not find that the core R&D activities that were claimed met the definition under the Tax Act. The reason for this was that the judge was not satisfied that there was a systematic progression of work based on principles of established science, where the taxpayer proceeded from a hypothesis to experimentation, and that led to evaluation and logical conclusions. What the judge found was that there was no evidence to demonstrate that the prototypes that were developed in relation to these shoe designs were tested in that systematic way. The second decision there is an ART decision. This particular decision has commentary in relation to the substantiation or documentation of R&D activities and the perceived statutory need for contemporaneous documentation when undertaking R&D activities. It was interesting to note here that the ART was of the view that Substantiation is not a legislated requirement, otherwise it would be within the Tax Act. Although not having legislation is not fatal to an R&D claim, it still remains important to continue to keep that contemporaneous documentation for the taxpayer to discharge its evidentiary burden in relation to following an experimental process and demonstrating that there is a hypothesis, there is an experimentation, and that there are logical conclusions that are drawn during an R&D activity process. So that does summarize all the R&D tax incentive updates, as well as our quarterly tax update for today. I'd like to thank my fellow presenters, Belinda and Grace, for taking us through their relevant updates and insights. I'd also like to thank those of you who have been able to join us for our quarterly update. If there are any questions that you have, please feel free to reach out to us. Otherwise, we look forward to seeing you at the next one.